Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host. And today I'm joined with Jean-Baptiste Wautier. How are you doing today, Jean-Baptiste?
Doing great. Thanks for having me, Kirk.
Yeah, glad to have you on. So tell us a bit about your background.
Yeah, so I've been, spending my entire career in the finance industry, more than 3 decades now. Most of it in private equity. I spent 20 years sort of managing a large buyout fund in Europe called BC Partners. So 45 billion assets under management, where I was CIO. And nowadays I do many things. I manage my own family office. I write, I give a few lectures and do a bit of philanthropy as well.
Nice. Nice. Well, with your background, maybe you could tell us, I'm curious in your thoughts, there's a lot of things going on in the world right now. Um, what do you think of it all? I mean, we've got tons of debt, we've got tons of changes in trends. There's lots of new trends. Like, how are you how are you looking at this slate of topics and trying to make sense of any of it?
Yeah, for sure. For sure, I find it's absolutely fascinating. I mean, there's always the temptation to feel that, you know, this time is different and this time is special. But I do think we're seeing an acceleration of, very big changes in terms of the way debt has been accumulated in Western economies, in terms of how much AI is a fourth industrial revolution, is going to impact our lives, is going to impact the economies, and is going to impact the geopolitical order. And last but not least, there seem to be more and more polarization in our democracies in terms of how people vote and how people tend to debate with one another. So I'm looking at this, trying to, as always, uh, reconcile the macro and the micro, understand where these trends are pushing us, what's the opportunity, because there's always opportunity in those big moments of change, and where the risk. But I have to say, for someone that is interested in history and economics, it's absolutely fascinating to watch.
Yeah, you'd mentioned kind of the polarization in democracies. I know there's a lot of populism out there right now with the um, distrust and mismanagement of the existing political systems.
Mhm.
Um, where do you think that ends up going? Because everyone always draws the conclusion of the extreme, like, oh, it's going to end up like the French Revolution, but it doesn't. That's one example in history. It doesn't always end up
Yeah.
in that. Um, do you think this is a path that could get us back to a normal political climate, or do you think we have to inevitably have a major disruption in order to do that?
Yeah, that's a great question. I mean, they like to say the worst is never certain, right? So let me be a bit of the optimist here, and not so much the French the Frenchman. But this is I, there's a few things that give me hope when I look at what has been happening in Italy, and where a leader who was described as extremist, populist, borderline fascist. Some people were calling her fascist. By doing the right things, fixing the economy, fixing public finances, putting immigration under control, etc., she managed to, get a lot of people back. And unlike all of the European leaders right now, she's still a very popular sitting president, and she's been one of the longest serving president, which in Italy is, the bar is low, but it looks like she's gonna be for another few years, and continuing to reform. And now she's getting influence in Europe. So she's shown that you don't need to be a populist to get people back and engage into our democracies. You just need to fix a certain number of issues. And I think the biggest issue that needs fixing is how middle class, how the economy works for the greater number, how affordability is fixed, how the younger generation can look at the future with a bit more optimism. And yes, it requires a lot of very courageous decisions, but I think there's a path to your question. I think there's a path. you really need some great leadership and brave leadership, because these are not easy decisions. They're not going to be popular decisions with a lot of people. But I think we can avoid the worst, if we have the right leadership and the right decision making.
Yeah, I agree. I think great leadership is really important, and I think the challenge is populism usually plays on people's baser instincts that
Mm,
they're very upset with the status quo, and typically it's not always the leadership that's the problem. Like in this
yeah,
country, the Federal Reserve ends up being one of the perpetrators, creating a
true.
K-shaped economy, and the rich are getting richer and the poor are not, and it's due to the policy primarily,
Mm.
not entirely, but in large part. Um, so, I mean, how do you fix stuff like that? Because at the end of the day, in my youth, I blame the Fed for a lot more. In my age, I realized like, what is the actual solution out? Like, let's say you gave me reins of the Fed tomorrow. Like, I don't know what I would do. Like, I don't know.
Yeah.
I'm not saying they did cause this, but like, how do you get out of it? I don't know how you actually get out of it without major pain. So what does that look like around the world? Because we have a huge amount of debt. It's only getting
Hmm.
worse.
Hmm.
We got demographic problems. We've got all sorts of problems around the world. And um, great leadership's helpful. I mean, like Milei did a great job
Yeah.
as a start, and that was everyone thought he would fail miserably, and he's actually
Mm.
done a great job.
Yeah.
Um, and so, how do we find our way through this, or is this a way without pain?
I think, yeah, I think there's a lot of great question in your question. I think if I can volunteer a bit of a contrarian view on the Fed and on central banks in general, I think there's a democratic issue, the way economic policy decisions are being made nowadays, because rates decisions, and even more nowadays QE and stuff, have become the most consequential economic decision a state can take, and yet there's absolutely no democratic control or vote, or a system whereby it has to be approved one way or the other, via an election. I think that's a problem. I think that's a problem because that aggravates the way people feel they're no longer represented, they're no longer heard, and that system works for the elite but doesn't work for them. So I'm not advocating central banks should be completely part of an administration. I think you still need independence for when crisis happens, and history has shown that. But I think there has to be a way where at least you have, you vote on a policy, or there's an element of democratic control on what central banks are doing. I think the current system is difficult to maintain. Now, to the bigger question of, is there a path without pain? I don't think there is, Kirk. I think the US might get away with it for a couple of reasons. One is the dollar, and the fact that financial markets nowadays, there's only the US. I mean, for a while when I started working, there was this hope that London would be, another big place, big global place, and for a while it was seen as, real competition for New York. It's no longer the case, and Asia is a very insulated set of markets. So I think right now the US have the ability to attract all of the savings, the global savings, and very smartly, the current administration is also using stablecoin to attract that even more. And if the US win the AI battle, and that yields to some accelerated growth and productivity, the US might get away with it, even though right now the situation is very fragile. Europe won't. Europe doesn't have a global currency that has the dollar domination, doesn't have financial market steps anymore, doesn't have the right, and it's not even a country to start with. It's a collection of countries. which are having a hard time agreeing on anything. So I think Europe is going to continue to erode in terms of economic influence, and there's going to be a lot of pain because there's no way you can fix the way Italy fixed their public finances. It was a hard medicine. France will have to do the same thing. The UK will have to do the same thing. And Germany right now is in a much better position, but the economy is has entered into some form of not depression yet, but at least slight regression. And it's not going to get any easier in the years to come. So I think Europe won't avoid the pain of fixing their public finances and shrinking public spending. I think the US, as I said, it's a, it's a very narrow path, but there is a path.
Europe is the U.S. is unique in many ways. I'm curious your thoughts on Europe. For a long time, like 15 years, people kept saying Europe's undervalued. Europe is it's going to start to take off, and it has in the last year. But it makes me scratch my head because Europe hasn't done anything to deserve that other than being a little bit undervalued. But it's been that way for a while.
Mm.
Um, Why do you think that the European markets are starting to take off, and do you think that's sustainable?
Yeah, it's a great question. I don't think it's sustainable. I think it's a blip. I think it's a blip because suddenly people were feeling like, oh, can we put all of our eggs into the US basket? Given, it's a very volatile administration that can take decision from one day to the next that can impact us drastically. Where is the dollar going? Isn't there a slow devaluation of the dollar ahead of us? How do we hedge for that? So there was all sorts of, sudden scares of, oh, we're too dependent on the US markets, we're too dependent on the dollar. But again, there's no alternative. So people suddenly saw or felt that there was undervaluation. If you just look at the premium between US and Europe, it used to be 0 to 10%, back in the days, 10, 15 years ago. Now it's 30, 40%. And suddenly people felt, oh, there must be value there. I don't think there is that much. I think it's still, the fundamentals remain. And yeah, from time to time, you might need to rebalance a bit your portfolio in terms of currency or places or geography. But I don't see Europe as undervalued. I think exactly along the lines of what you said. That blip of, suddenly, oh, it's a bit more attractive is a blip because fundamentally nothing has changed. And all of the things we said about depth of financial markets, single market and importance of the dollar will remain for the years to come. And that will be to the detriment of Europe.
Do you think over the years I've noticed that people try to discern what moves markets, and I think the one thing that I've seen that always does is money flows, and
Yeah.
I feel like with Trump pushing back on Europe and saying you should pay for your own stuff, you pay for your own military and all these other things, that seemingly is going to put more money to be spent in the economy or mainly defense, but they're into the economy. Do you think that is the reason, or do you think it's just like you said, frustration with the U.S. because the U.S. is still doing well this year? I mean, it's there's
Yeah,
still the
very
markets are
much
still
so.
going up despite the fact that not much has changed.
Yeah, very much so. No, I think I don't see, people are hopeful that there's going to be a wave of investment, and defense is one, but there was a Draghi commissioned a report last year advocating that Europe should spend nearly $1 trillion on R&D, and not only defense but AI, and trying to just get back in the race. Um, but it's just not happening. I mean, look at the biggest contributors to the potential defense spending would be UK, Germany, France, and Italy to some extent. Um, they can't even agree on who's going to do what, let alone the fact that France still doesn't have a budget, that Germany is a very difficult coalition to navigate, and that the UK is trying to plug a hole of 20 or 30 billion of public deficit, and they can't seem to find a way to do so. So they just there's no money's coming to the rescue here, and I think it's going to be again, it's going to be. I think it was, as I said, a blip. I don't see a big wave of investment. Unfortunately for Europe, a big wave of investment coming, and that's why I'm quite pessimistic on the fundamentals going forward.
Okay. Well, it's good to know. What do you think about emerging markets and China? I mean, China is a whole nother ball of wax, but you know, they've been certainly doing well. And what do you think of those? Maybe some of the BRIC countries and China.
Yeah, yeah. I think um, it's funny because the we keep calling them emerging market, but as you said, China is has become a superpower, the second superpower globally. And when you look at the BRICS now, GDP wise, are bigger than the G7. So it's sort of, it's fascinating how we keep using that language we've been used to, whereas there's a whole seismic shift in terms of global importance. So starting with China, I mean, to me, China, if you look at the economy, if you look at the R&D, if you look at IP, where they stand in the AI race, if you look at military, um, they've become the alternative superpower to the US. They're not the same size in terms of economy, but they're getting there. What they're lacking is financial markets and global currency. But from a military perspective, they've surpassed the US Navy last year. They're building capabilities hand over fist. So they have become, in my mind, a superpower, and they are the real challenge to the US in AI. And today, if you ask most people, it's still very undecided who's going to win that race. But it really feels like an arms race. So to me, China, you can no longer ignore China. Back to your question, you can no longer ignore China if you're trying to think global asset allocation, portfolio and the rest of it. It's still hard to understand the kind of geopolitical risk and regulatory risk you take when you invest in China. That's the tricky bit. But more and more people are putting Alibaba and Tencent and stuff in their portfolio because you just need that edge, and you just need that big slice of GDP and growth and AI in your portfolio. And then the rest of the BRICS, I mean, it's much harder because yes, they try and behave as a group, and that's why BRICS is sort of becoming more and more structured. They're trying to find if they can, generate an alternative to the dollar in terms of currency, if they can geopolitically be influential. Now, it's such a combination of very different countries. In there you're going to have Russia, South Africa, Brazil. Like it's very different, set of geopolitical realities, agendas, geographies, and stuff. So I don't see them as one unit, even though they're trying to become one. I think there's a few countries in there really trying to make this a tighter unit. India is pushing hard. Russia is pushing hard for other reasons that economical. And in the Middle East, Saudi Arabia is pushing hard, and more you see those names, in big geopolitical movements and participating to AI, investing massively either in the US or in China or in both. So these are forces to be reckoned with. I don't think they are there yet in terms of how they are must have in your portfolio, but certainly in terms of economic weight and geopolitical weight, it has completely changed versus maybe 10 years ago.
Yeah, I find it interesting. I think a lot of good stuff's going on there. One question I had was, um, in the last administration under Biden, there were a lot of unforced errors with the dollar
Mm.
hegemony, and um, I wonder where does this go? Because I mean, in the last 4 years, they did some things like
Yeah,
trying to take other countries' reserves, like
yeah,
Russia. Like I think that was just dumb. it certainly
Wasn't
has
the best
helped.
move.
No, it wasn't. It was a very, very bad move. Um, no matter what you think of Russia, that's just not,
Exactly.
that's
Yeah.
yeah, that's a big error. And obviously that's pushed a lot into gold and
Yeah.
countries just saying, well, you can't take our gold, so we're gonna go do this again.
Mhm.
So where do you think that ends up? Like, what do you think it ends up with the dollar,
Yeah.
with gold? Like, do you think this continues along this path, or do you think they can maybe save it?
Yeah. I think, yeah, it's a fascinating one because if you look at the data, so you look at reserves, you look at Swift data, et cetera, the dollar is just, 80%, between 70 and 80%, depending on the KPI you take. And so it's been, and if you look at longer series, sort of until 10 years ago, euro was gradually increasing, very gradually, but markedly. And renminbi was appearing as a potential alternative. These things have just disappeared. So despite the previous administration mistakes and stuff, the dollar is, that's why I was saying earlier, I think the dollar it's game over. No currency, no fiat currency is able to challenge the dollar today. Despite all of the attempts by the Chinese, by the Europeans, by the countries in the Middle East, it's just not happening. So and that led to that whole movement, as you said, on gold, and I think to some extent on cryptocurrencies at large, because suddenly investors were like, okay, so how do I hedge? Like, okay, I get it. The dollar won't be replaced because this just it's the famous TINA, right? There is no alternative. It's the new TINA trade, which is the dollar. So how do I hedge? It's what we were discussing earlier. How do I make sure that if I think the dollar is going to depreciate, or the US could do some silly things with my dollars, how do I hedge for that? And that's the whole trade on gold. And I thought for nearly 40 years I would never buy gold ever because I couldn't understand the way it was trading, and if I don't understand, I shouldn't invest. And for the first time, 6 months ago, I invested in gold as a hedge, not as an investment, as a hedge, just in case. Because when you're so dependent on just one currency, one country, there's always a risk there. But I think that I see this as continuing. The big question mark are cryptocurrencies and whether at some point one of those, and right now, that's where I think the current administration is incredibly smart, is what the strategy on stable coin is trying to, they can see that crypto is a threat to the potential traditional dollar. They've identified that, and it can go very quickly because a cryptocurrency is so much more efficient. It's so, the younger generation, all of my kids just they speak that language. And it just makes sense. I mean, even Diamond, recognize that, yeah, blockchain or think, or all the great leaders on Wall Street all have to acknowledge that. So they've quickly realized that, and so they said, okay, how do I capture this? And pegging a crypto to the dollar with the stable coin that they're pushing is, I think, a very clever way of trying to capture those future trillions. So to me, that's the big question mark: is there another crypto out there that's gonna suddenly be seen as a hedge to the dollar? And right now, this is not happening. I think my conviction is that it can't be a pure crypto like Bitcoin, because I don't think most investors, or just a man on the street, is ready to trust a system that has um, no central backing, in a way. Like there's no big authority that says, I guarantee you that this dollar will be worth $1 tomorrow. I think it's very hard for most investors and for most human beings to be comfortable with that idea that there's no supervision, no control, no, it's all decentralized. So then it would have to be either China or Europe getting their acts together on the cryptocurrency front. Europeans are trying to get their acts together, but as always, they can't agree. There's just too many of them. And China will always be a bit stigmatized because people will suspect political agenda behind that. But to me, that's where the question mark is, whether there's a crypto out there that can just take everything by storm and become a real alternative in addition to gold.
Yeah. So when you're talking about crypto and stablecoin, obviously Bitcoin is the it's the granddaddy of them all, and that's
Yeah.
what people put their most trust in, and yet uh, it doesn't have as functional use, kind of like
Mm.
like with Ethereum, for instance.
Yeah. Yeah.
There's
Yeah.
a practical use case with Bitcoin is not so much, but yet everyone puts faith in that. How does that play in, and in comparison to like stable coins, for example? Because stable
Yeah.
coins, a lot of people are basing or investing in crypto because they're appreciating. It's not for the use case. It's a store of wealth, which is really speculation.
Exactly.
But with stable coins, you don't necessarily have that. So how do you see that all playing in daily life?
Yeah. I think it's this is where age and experience can help because back in the 80s, when European currencies were fluctuating all over the place and could be devaluated by, I don't know, 20% overnight by their respective governments. That happened to France in the 80s. But remember also in the UK in the 90s, where the IMF had to step in, and the British pound had to be suspended from the monetary system. So the reason why I'm talking about those old stories is because back in the days, people realized that they don't like things that can move that much every day as a currency. And I think that's the problem I see with Bitcoin is first of all, it's exactly what you said. People just got in thinking, I don't know if it was FOMO or whatever, but like it's going up. It's like real estate bubble, right? It's gonna go up. This is the thing I need to own, and or AI stocks or Max 7, or I need to own this thing because it can only go up. And we both know that it's not, life is not like this. Yeah, things can go up, and at some point they can go down. And a currency to be able to be seen as a reserve currency or a currency of reference for a lot of people, you can't have movements of 5, 6, 7, 10% in a day. It just doesn't work. It won't work for people. And I think that's my issue with those pure cryptos and Bitcoin being one of them is they're just too volatile. And yes, there's been a fad of, it's always going to go up and it's going to go to whatever, 1 million, like people, like to say all sorts of things. And suddenly now I haven't followed the last few days, but it's come down, what, 20 or 30% from its peak in the last few days or few weeks. How can you be, how can you be a currency that people are going to use if they can lose 20% in a couple of weeks? I just don't see this happening. So to me, that's the issue with crypto. And this is why I think so. If you can have all the benefits of Bitcoin, i.e., you heavily decentralized, people understand how this works, but you don't have the volatility of Bitcoin, maybe that can work. But right now, I just don't see who would be the right candidate, and that's why I was saying earlier, maybe it's still to come. Who knows? Especially at a time where, as we said, history seems to accelerate. But right now, I don't think Bitcoin is a good candidate for that reason, unless something structural happens to Bitcoin, which makes it far less volatile. But again, people would need to build trust that it's a new Bitcoin and it can't lose 10% in a day.
Yeah, no, I mean, that's a great point, and that's certainly a great reason not to own it. Although people don't like the volatility when it's going down, but they like the volatility when it's going up.
Very
So,
true. Very true. For
you
some
know,
reason.
um, but it does seem, and I would suspect that all of the institutional money going in now will reduce the volatility quite a bit. I mean, you used to get
Yeah.
70% drawdowns. I'm not sure if you'll see that anymore, just based on the institutional money, it being more sticky. So I really don't know, but I suspect that there'll be maybe less volatility as the price rises. So, as it gets close to like $1 million, my suspicion is it probably won't move that much at all. But
Yeah.
you're still talking 7 years from now, so it's not
Mm.
exactly close. But um, well, good. So I have some questions about AI. Actually, before we get into AI, I want to hear your
Hmm.
thoughts on debt. Um, we seem to be in this uh, debt spiral, which there doesn't seem to be a way out of it.
Hmm.
The U.S., pretty much every sovereign country has this problem, except for I think Russia, Saudi Arabia, countries that have gotten spurned by us in the past with the
Yeah.
debt, and they've gotten smarter and they're not,
Yeah.
creating as much debt. But uh, if you look at pretty much any developed country, they've got a huge debt problem. Is there a way out of this? How does this get solved without, I guess, a massive default or a debt jubilee? And maybe that is the
Mm.
solution. But how does this get solved?
Yeah, I think it's you spot on. If you look at there was a recent IMF study which shows that we are as globally we're at an all-time high. And the last time we were that high um, was, I think, during Napoleonic Wars. But even World War II, which was a peak for many countries, for the world as a whole, was not as high in terms of debt to GDP as it is now. So there is a global debt problem. Um, Again, I think it's um, you can't just treat it globally because every situation is different. Like look at US, Japan, and some countries in Europe. US, we talked about it. US may get away with murder, and if US gets away with murder, what prevents them from going to 200% debt to GDP like Japan has been for so many years? Why not? If the global savings being are all going to the US, are all going to the dollar, it will be sustainable until it's not. But in the next 10 years, it can happen. So I think again the US as a particular envious position. Since we're talking about Japan, I think Japan is a huge question mark. Now that these years of zero interest rates are behind us, they still at 200 debt to GDP, but the cost of that debt is going to go through the roof. And you rightly talked about demographics. These guys are just their population has started going down. So I don't know how you make the math work for Japan. And is it a default? In that case, probably because they have a large portion of the debt which is local. So it's quote unquote easier if it's local than if it's international. So I think Japan might need to go through some way of defaulting, extending, jubilee, whatever, but asking their local investors and institutions to just sacrifice themselves for the greater good and for the benefit of their country. Um, Europe, which is another big pile of debt, um, there would be a solution if they were to become a proper federal state. If suddenly you had France, UK, Germany, Italy, Spain getting together saying we're just one country now, we're just a federal country, but we become just one unit. Suddenly the numbers look much better. But it just and hopefully there's some efficiencies in doing that, like there is in merging two companies, in terms of overhead and what have you, but or corporate mergers or whatever. But I just don't see this happening. So that's why I'm so um, pessimistic about an easy way out for European countries, for the major European countries, because if they don't do that, there's no easy exit. So there, I think the risk of not necessarily default, but sort of central banks, European Central Bank or IMF stepping in saying, now you're going to have to do the right thing. just like it happened with Spain and Portugal and Greece, more than 10 years ago. I think that risk is very high. And so it's going to be a messy restructuring. They're going to have to shrink public spending. When they went to Portugal, they took retirement down by on an average of 20%, same for civil servants comp and stuff. So this is, there I think it's going to be much more painful. And last but not least, China has a huge pile of debt now as well. It's very hard. I'm not even sure we're looking at the right numbers,
Right.
frankly. It's a very opaque economy. I'm not sure what they report is actual. It's hard to understand who owns what in that system and whether they could just like Japan, have a local solution to their problems. I think they have such an economic preeminence now in the region in Asia, and they have a lot of their lenders, if they're not local, but Japan, Korea, that I think they have probably not an easy local restructuring, but I think they can manage. I think a bit like the US, they can probably manage for other reasons, but they can probably manage. So that's how I think you. But you're right. This can't go on like this for another 10 or 15 years. This will have to find its way of reducing.
I'd heard something the other day, and it just hit me in the face because it was so obvious, and yet no one's noticed this. So there's kind of a rumor going around that the China's population is overstated by about a billion, because they had about 400 million after the Great Famine, and then
Hmm.
they had a one-child policy, and somehow it's
They
increased
ended
from
up with
400
1.4.
million to
Yeah,
1.3. And
yeah,
with a one child policy, like, let's see, maybe
yeah.
that's one of
How
those
does
data
that work?
points. So
Yeah,
I look at China, and honestly, I don't know what to think, because yeah, there's plenty of opportunity, and yes, they're in my opinion, they're one of the best managed countries. You might
yeah,
disagree with a lot of things they're doing, but they're very well managed for, like, 20, 50, 100 years from now. So I
yeah.
give them a lot of credit in that regards. But on the other hand, I look at it and say, how is it even investable if you
Hmm.
can't trust any of the data? Now, I'm not saying that we trust our data, because I don't trust our data, our government data. I think it's all fabricated anyway. But China's, that plus the fact that Xi could just come out and just say, we're going to be communists now. I
Hmm.
think it was like
Hmm.
2 years ago where he came out and just said,
Yeah,
"Yeah,
yeah.
you guys are being too successful. We're going to knock you down a notch," and everyone just took their money out of China. So that concerns me, but yet there's an opportunity there as well. So how do you even look at China? Is it even investable?
I think, yeah, I mean, all of your points are incredibly valid, obviously, and that's why early on I was saying, people have stayed away from China for a while, and that includes me, because of all those political risk and opaqueness. And yeah, people should always be skeptical when data are being produced by an administration. You're absolutely right. And it's a question of magnitude, I guess. In the case of the US versus China, the order of magnitude is a bit different. And this is where, and yes, you can always have a regime change. You can always have, a local regulation which says, okay, from now on, these shares belong to the government, and what do you do? So, but I do think it has become investable because it's become too big not to be invested in. That's the way I look at it. So you need to be mindful of those risks, which are different risk set to the US, or what we used to in the Western world, and understand, just like when people were investing in, I don't know, in Brazil or in Argentina 20 years ago, hopefully they knew that when it comes to currency or administration or regime or whatever, they were running a big risk. I think China, you need a bigger premium for all those reasons. But I think it's a very, if I were looking at building a portfolio, for example, and make sure that I get the right exposure to what's going to happen in the AI space, I think it would be remiss slash risky just to invest in US names and not have any exposure to Chinese names. So I think yes, I think it's become investable because it's become too hard, too big to avoid. It doesn't mean that the risk is still there. So you need to be conscious of those risks. And I think at any point, I would agree with you on how well China has managed itself over the millennia, and it's always the same thing. So try and think what is Chinese interest when you invest in China, right? And make sure that you have some vague alignment with what's going to be the country's interest. That might save you from any mishaps that happens locally because it's there's one thing you can be sure of. Yes, there might be ideology along the way, like they had under Mao Zedong or things like that. But by and large, you look at the last 2,000 years, they've always tried and act in the Chinese best interest long term. It's been the direction of travel. So if I were to invest now in Chinese names, I would think, okay, how do they align with the country's interest? How are they exposed to the right trends there? But yeah, I don't think you can skip China anymore.
So before we get into AI, I wanted to ask you about just kind of follow up on Japan because Japan, as some people have said, is a bug in search of a windshield for quite some time, and it makes me wonder. I mean, when you have 0% rates, you can have debt to GDP of infinity because it's zero.
Mm,
But
yeah.
now that rates are climbing, deliberately so,
Mm,
they're they have potential problems as you stated. But I wonder, like, at what point does that become problematic? Because they've gotten away with this for a long time. But at what point is it actually
yeah.
problematic for with them where it starts to impact, their economy? Because right
Yeah.
now their stock market's doing great.
No, the stock market is doing great, and people are trying to understand the recent run. But the I think it's always the same to me when I look at these things. I try, even though even the IMF likes to talk about things in relation to GDP, whether it's debt or deficit or whatever. Um, I always like to look at it as if it was a P&L and what's your inflow, what's your outflow, what's your deficit, and what's the size of your debt service as a percentage of your revenues. And by the way, this is what I'm obsessing with when I look at the US. I don't worry so much about the 115 or 120% debt to GDP or the 7%. I look at it's more than 1 trillion of debt service, and it's bigger than the US defense budget. And that I think is the way to look at Japan because they it's gonna become a huge proportion of their income as a state, the debt service. And so let's forget about the 200, 220, whatever it is. I think the issue is going to be when your debt service becomes 20 or 30% of your budget, you're in trouble. You're really in trouble. And even more so if you have no growth or very low growth and the population decline. And it's not like they can suddenly become the most attractive country in the world. No one's going to move to Japan. It's an island. It's quite isolated. It's not the easiest society to integrate, and they're not going to do it anyway. So they're gonna have to just retrench at some point. And again, I think, and this is going to come. So I can't tell you if it's a year, 2 years, three. It really depends how quickly rates go up and how quickly population goes down. But they're gonna have to solve this issue. I mean, they're gonna enter into unsustainable position when again debt service is 20, 25, 30% of their total inflows. But as we said earlier, I think there would be a domestic solution because more than half of this debt is with local banks, local institutions, savings. They're going to have to sacrifice a lot of this money in order to restructure the budget, but I think it's doable. I just think that economically they're going to continue to shrink, but that's a long-term trend.
But I think many countries have a negative demographic trend. I mean, Japan's the
True.
most notable,
Yeah.
but I mean, the US has one, France has
Yeah.
one, there's a lot
Yeah.
of European countries have it. And so,
Yeah.
how do the traditional economic models say that you need to grow your population or to grow your GDP, which I
Mm.
think is insanity because some of the stuff they're doing seems to be for that purpose alone and damn everything else, despite all of the social implications.
Mm.
So, what is what is a solution that doesn't include completely disrupting the social aspects of an economy like I know like UK is doing right now.
Yeah. Yeah.
Um, how do you does it really matter? Like, should we just change our standards? Because to me, it seems like it's causing more problems than it's solving.
Yeah. This is you're right. And if you look at the big picture is global population is still increasing despite all of the negative demographics in the Western world and parts of Asia. Um, but it's gonna start. It has passed an inflection point. It's gonna plateau pretty much around 10 billion in the next 5 to 10 years. Now, unless something big happens, but in current conditions. Now, the you're right. You can't just say, for countries which have 1.2, 1.3, 1.4, most European countries, as you said, are at that level, 1.5 for the best of in terms of birth rate. So you have a structural problem. I think it's too big to be solved by mass immigration and just making sure you select the right people, you integrate them well, they bring their skills, you give them a job, you give them the right conditions. Culturally, the melting pot works, etc., etc. I think the numbers stop working because we it's just too big. What you need to plug the hole. Now, this is where there's an interesting bridge with AI because AI is could be the answer to the fact that uh, you don't need to add humans anymore to grow your economy. Just because AI is potentially replacing, not replacing, but could be used in sort of 80% of jobs. And so it might be that what you used to look for, which was either I need volume or I need productivity or I need both, is now gonna come from technology. This is also to me the worrying aspect, which is if AI is really gonna replace humans in a meaningful way while maintaining the sort of the wealth creation or the GDP, whichever way you measure, um, we're gonna have an employment problem, not just a demographic problem, but it's potentially going too fast to keep people busy, to keep the whole of a population busy. So to me, this is where AI might be the answer to this demographic issue, but could also be a very disruptive event to the way our economies are working.
So, I know we're getting close to time. We're gonna wrap it up here, but what are your thoughts on AI? Like, I'm of two minds on it. I look at it and one and say, oh, it's, our minds always go to the extremes. Like, oh, it's going to
Mm,
be
yeah,
Star Trek or it's going to end up being the Terminator, right? And yet I have this sneaking feeling that it's going to be neither, and it's going to take a lot longer to be where we want to be, and it's not going to progress in the state that we are. I feel like maybe over the next 20 years it might, but not. I think not at the pace that we're seeing now. I have this suspicion it's going to underwhelm us in both productivity and usefulness. Um, but it's just kind of from seeing this cycle before. Like, what are your thoughts on it? Where do you think this is going to go? What do you think this does to the global economy? And do you think this will be what they're claiming or some lesser version?
yeah. I think, I mean, I have the same privileges as you, having seen, other cycles and the internet frenzy, late 90s, early 2000. And And yes, it was a revolution, but it was not as big as people predicted, and a lot of wealth was distracted along the way after the bubble burst. So I think there's, if we leave aside the sort of stock market aspects for a while and just focus on the very fundamentals, I would tend to agree with you that I don't know if it's going to underwhelm us, but it's going to take much more time. Um, and the reason why I'm saying that is because you look at the speed of adoption in certain industries, despite the quality of AI. Look at healthcare. You know, nowadays every scan, every radiologist should have been replaced by AI. AI has proven that it was doing better than the best radiologist reviewed by the second best radiologist in the world. It's sort of 93% instead of 80%. Look at some legal contract review and stuff like that. Look at accounting. So there's many places where AI already has proven its value, and yet it's not progressing that fast. Why? Because there's resistance. People resist to change. People resist to the fact that they're going to lose their job or they're going to make people redundant. People resist to technology, and we need to completely change the way education works. And it's going too fast. Previous industrial revolution were like 25 or 30 years, so you could reskill people. You had plenty of time to reskill people. Nowadays, this is not happening, and we're not seeing the job creation on the Max 7. You look at the Max 7, how many people they employ, it's zero compared to the previous industrial revolution, where the Titans would employ 500,000, 1 million people. Nowadays they employ 50,000, 100,000. It's ridiculous. So it feels to me technology is going too fast compared to how humans can do and how societies can adapt. So that's why we're not seeing productivity gains. That's why we're not seeing now. I think so. Yes, it's going to take a lot of time because of those frictions. Now, I think longer term, I think it's massive because um, I see it in finance. I mean, you see it as well. When you have banks like JP Morgan saying we're not going to hire this year because we don't need to. When you have large PE funds like Vista saying we think we can reduce headcount by 20 or 30%. I mean, these are real big organizations and these are real numbers. And I'm sure you use it every day, and so do I. It's fascinating what you can see. For my family office last year, we were thinking we're going to need to hire 2 young graduates to do our research and to prepare briefs and stuff, and we didn't do it because AI does it better. So I do think that the economic impact is gigantic. It's just that it's going to take much more time. There's going to be casualties along the way because not everyone is going to be a winner in this race. And I hope this time gives us the ability to rethink society, because I think it's going to change. When you try and think, okay, what are the jobs out there which require a good memory, a lot of hours spent reading stuff, digesting stuff, summarizing stuff, connecting dots? It's a lot of office jobs, and they're going to be much better done by AI. So, but we're not ready. We're not ready for this. But I think in the long run, so the long run is what, 5 years, 10 years? I don't know. It's at least that. It's going to be a very different world we live in, and I think this will involve also rethinking. I'm not sure GDP will be the only measure of economic progress by then, but that's probably for another podcast episode.
Yeah, I would agree with that. I don't think GDP is useful at all. Especially when it's 40% accurate when they release it and 90% accurate like 9 months later, which when no
Yeah,
one's looking at it. So I
exactly.
think a lot of government metrics are just useless nowadays.
Yeah.
But that's a different story for a different day. Well, Jean-Baptiste, I really appreciate you coming to the show, sharing your wisdom. Any final thoughts, and where can people find more about you?
Yeah, no, I mean, listen, I enjoyed it. So thank you for that, Kirk. It was a fascinating discussion. I'm always interested in brainstorming, sharing views and stuff. So people want to have a look at my articles or YouTube channel or whatever, they can find it on my website, which is Wautier, wautier.co.uk. But yeah, I think we covered all the most pressing topics in a limited amount of time. So I really enjoyed it. It was great.
Yeah, I really appreciate you coming to the show. This has been a fun conversation, so thanks again. We'll have you back on the future, and thanks for joining us today.
It's going to be with great pleasure. Thank you, Kirk.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Jean-Baptiste. Really appreciate him coming to the show. Now we're into the panel portion of the show with Barb Friedberg. Hey, Barb.
Hi, Mark. Happy to be here on this final day of 2025.
Yeah, we are recording this on New Year's Eve day, and it's glorious. Just me and Barb. Everyone else is out drinking, starting early, getting wasted. No,
Not
no,
us.
not
Not us.
us.
We're always here working.
Yeah, or the wholesome twosome.
Yes, yes, yes.
Yeah. So let's dive right in. So, Barb, what were some of your takeaways from the interview?
There was so much content there and broad discussion of crypto, of global markets, of economics, that I'm kind of hard pressed to say which is, what to talk about. But I think the takeaway is kind of taking a broad look, not at the US or not at just our economy or just our investments, but take a look at the global investment world, what's happened last year, and what we can expect for the year to come.
Yeah, no, this is a good time of the year to do kind of a reset and to check, what you're doing. And, I always use this time of year as a chance to look at my portfolio with fresh eyes and say, each position, say, would I buy this position today? Would I, have this allocation if I were to start today? And really just kind of looking at everything with a fresh set of eyes because it's hard to do in the moment. Since everyone's setting up their New Year's resolutions, which are usually bunk, it's something to make you feel good that you never actually accomplish. And there's reasons for that. But it's a good time of year to do a refresh. And so every year I take the last 2 weeks off and I really focus on my business, my life, portfolios and really just kind of look at everything with a fresh set of eyes because it's really hard to do in the moment. So we're going to do a little bit of that today. We're going to look through, because Jean-Baptiste, we talked about a lot of areas in the interview. We really want to kind of run through our kind of year-end look at what's going on. So let's start with the stock market. So, in regards to the stock market, Barb, what were some things that you liked, didn't like? What kind of happened this year?
This year we ended up the S&P, without checking my notes, approximately 17% up, which is very much higher than the 12% average, 11% average. And that was dominated by a small group of tech stocks, AI stocks, very, very fast growers. And then globally, the US has been, the international markets have been up on a tear like they haven't seen in years. Growth has continued to surpass value investing, with small caps showing close to 20% growth this year, which is a switch for what has happened with small caps over the past. Even global and US REITs. Global has been about 10%, US REITs about 8%. So if I can sum up the markets this year, and bonds have been up as well. So if I can sum up the markets this year, it's been pretty extraordinary. And most of us who are invested in the markets are feeling quite a bit richer than we were at the end of last year. So what does that mean for next year? Do we think that things are just going to continue going up, 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 and we should just hang on and get going? Well, I really liked what you said, Kirk, at the outset, that you look at your portfolio and you say, would I have this asset allocation today? Would I invest in what I'm invested in now today? Because that's always a reason to sell. If you would not invest in the holding you have today, then maybe you need to sell it. And so for today, it's a really good time to take a look and make decisions about, do you think the markets are going to continue with these type of exceptionally outsized returns? Or do you think we might be going back towards the mean returns, which are substantially lower across the board in the future? Thoughts, Kirk?
Yeah, there's actually a few things I wanted to cover here, and I'm going to share a few charts because I think it's going to be helpful. So we were talking about the S&P 500. This is actually the historical 100-year, approximately 100 years of returns for the S&P 500. And I wanted to point out, I mean, if you look back in the latter half of the 1900s, you saw a lot of up and downs. But I wanted to draw your attention here to the more recent 2020. You're looking at close to 20% returns a year. You had one bad year, obviously, but we don't have a lot of under 10% returns. And I found this. I did a study on this a few years ago because I was looking for ways to invest that are low risk and high opportunity. And one of the things I noticed was if you're looking at 10%, the vast majority of the time, like I think it's like somewhere like 70+% of the time, the index is either greater than 10% or goes down further than -10. It's like plus or minus 10%, like rarely happens. And it certainly happened back here in the mid to late 1900s, but if you look back since 2000, it rarely happens. It did kind of the early 2000s because things were kind of a mess. But if you look at the last few years, it's really like every year's like close to 20% returns, except for 22. So I just wanted to draw that because I find it interesting. Like each year, it's like it's going up 20%, and that's not normal. So that's why I'm pointing this out. If you look at this, that's not normal, but that seems to be what's going on here. Kind of like in the late 90s, where you pretty much had 20% plus a year for the S&P 500, and then you had 3 bad years. But I just want to draw that note because I think we all tend to get lost in the moment of what's really going on, and I really want people to understand like the normality of things. I also want to point out some other things that I noticed, and I'm going to share it here. And one of them is, so this is the annual returns for the S&P 500 stocks. Now, this is through FinViz, so they have a really great map, a heat map as they call it. And I love looking at this because it helps you, especially people that their mind works like this. Like I like to look at the big picture. Now, if you look at this, you notice a handful of things. There's definitely some big outperformers, right? If you look at Google, 65%, Nvidia's up 40%. You've got the financials, the big financials, JP Morgan, Bank of America, Wells Fargo, Citigroup's up 60%. You got some big performers here. In the financial sector. No one's talking about the financials, which is interesting. I don't hear anyone talking about, oh my God, we got to invest in the financials because they're usually very sleepy. But this year they were fantastic. If you look at the capital markets, Morgan Stanley's up 40, Goldman's up 53, Schwab's up 35, Robinhood's up 207. I didn't even, what the heck? Okay, that's weird. Robinhood's up 207. That totally blew me away. I didn't see that until just now. And then you look at areas like other areas in the market. You look at semiconductors, obviously great. You got some 50, 100% plus returns. That was a big area. Semiconductors, this is the semiconductor equipments. These are the semiconductors you're looking at 40, 50, 80, 200, 40. Like there's some huge returns here. Then, of course, up in software, you've got Palantir, but the rest of this, and CrowdStrike, but the rest of the sector was actually kind of sleepy. So I want to point this out. We just talked about a bunch of tech, right? Big tech is done reasonably well, although not all big tech. Some big tech's been a little sleepy. But look at the sectors. Software. A lot of software was negative. If you look at the software sector overall, I think the software index, I have to go back and look which one it was, but it was like negative 5% for the year. Negative 5% in a year where the market's up 17, where everything's doing great and, AI is doing great. And yet software is lagging, right? Salesforce down 20%, Adobe down 21%. ServiceNow down 27%. You go up here, you go Blocks down 23%. Global Payments, GoDaddy. You look at all these software areas, and they're just getting mauled in a year of great returns. And so what I find interesting in times like this is really looking through these areas and saying, all right, where are the opportunities? Now, I'm not one to catch a falling knife. I'm going to be the first one to tell you, don't do that, right? Don't catch a falling knife. If things are bad, let them be bad and wait until they turn around. You don't want to be the first one to try to catch a falling knife because you know where the bottom is. Friday will be kind of a non-starter because no one's working. But I would say as of Monday, on the 5th, I think it's January 5th, if you start to see some big market moves, I would pay attention to that because that's where the big money is trying to put money this year. So I would pay attention to that. Software is actually interesting to me because everything else is taken off and software is taking a back seat. And there's some good values here. Barb's a value gal, and I'm a very value guy. Like I've already started to look at this. You can see some good values in this sector. So that's the sector I'd probably pay attention to. Also, if you look at consulting, IT consulting, if you will, there's definitely some interesting values there because the government, Doge, knocked a lot of the price off, although I don't think it did all that much. But anyway, and then you could look at some other areas. Look at household, defensive consumer goods. It did not do all that well. Restaurant sector did not do all that well. It's starting to get impacted because people apparently aren't eating out. So if you look at like the consumer goods sector, there's actually some interesting areas. I'm not sure if it's time to buy yet, but it's definitely interesting. But you can find some interesting values here. And then I'd also look at healthcare. I think healthcare has obviously gotten beaten up this past year, although it's coming back quite a bit. There's definitely been some momentum in that area. I mean, look at Eli Lilly, which is It's an expensive stock, but it's done very well this year. So I think you can definitely find some interesting areas. And the last area, well, the last two areas, real estate's gotten beat up a lot, and rightfully so. That should actually start to do better as the interest rates drop. That should, quote unquote, should improve that area, but not necessarily because there's a lot of excess in the commercial real estate market that needs to be burned off, and that'll take some time. And the last area I want to point out, which is of interest, is energy. Energy, people have been talking about energy for the last 6 months. Oh, energy is going to start to take off. I'm of two minds on energy. I think energy is it's an interesting value. I don't think that energy is going to take off before the midterms. I think Trump very desperately wants to retain power for the last 2 years of his term. In order to do that, he needs to make everything really, really warm and cozy for people as much as possible. He's in a tough spot. The economy's, I think, should have been in a recession years ago, and we're not yet. And I think we probably should be. At the same time, we've got our K-shaped economy. The good stuff's getting better, the bad stuff's getting worse. Um, but he wants to make things less bad for people, and low oil prices will do that. And so he wants to keep it low. So I think oil prices will probably stay low until maybe the fall, right before the election. They might pick up a little bit, but generally I think they'll stay low. That's a prediction. I don't know if it's true, but I'm keeping an eye on energy because I think there's a lot of value there that potentially could do really well. And I think it's just a matter of time before it does. So that's kind of a quick breakdown. And I'm just sharing this for Barb's edification, just so we can kind of talk about things. Um, let's see. So this is where's the year to date? Oh, here we go. So this is the performance for year to date. If you see here for commodities, silver's obviously done really well. Platinum, palladium, gold. We talked a lot about that this year, so we're not going to overdo it on this episode. But those four have done really well, especially silver and gold. Copper's starting to pick up. If you look at these, if you look at the areas that haven't done well, there's a lot of ag, corn, soybeans, oats, canola, basically a lot of the ag stuff, wheat, rough rice, cocoa actually had some other issues over in Africa where most of it comes from. But if you look at that, that area has gotten beaten up a lot. So it's an area that you might want to pay attention to because it's actually gotten beat up quite a bit. So it's worth paying attention to that because I do think that there's going to be some interesting opportunities there eventually. Maybe not now. If you look at the Russell 2000, it's only up around 8%. The S&P, that doesn't seem right. It says here 12%. That doesn't seem right. I don't know what's going
I
on
don't
here.
think that's right.
No, that's not right. I don't know why this. I don't know. Anyway, I wouldn't mark this too much. But anyway, I will point out one thing. So the Nikkei. I want to point this out because we don't often look at international markets, but I want to kind of share this really quick. So Nikkei, which is Japan, this is this year. Obviously, everything got taken to the cleaners in April, but it's performed extraordinarily well. And it's silent. No one's talking about Japan, but Japan is one of the best values globally. Is one of my favorite areas, especially small cap in Japan. It is one of the best areas of value. It's kind of like I would have put it akin. Barb, you remember in like the 70s, or was it the 70s or 80s where what was that movie? Or the book, Barbarians of the Gate. Remember that one with the RJR Nabisco? Well, during that period, a lot of companies had value just locked up in their books, right? Pension, like overfunded pensions, all this stuff. And then the Raiders came in and they started to unlock that value. Rightly or wrongly, could argue. But anyway, it's a capitalistic market and that's how it works. So they unlocked a lot of that value and it produced a lot of positive returns. Now, Japan has a similar situation where there's a lot of value locked up in real estate, in cash that they're just sitting on because they're trying to be conservative. And a lot of people are going in and saying, "Hey, you need to unlock that value. Like, there's a ton of value there." So I've been following Japan for like the last 10 years, and it's just been sitting there. And I think finally they're starting to unlock it. So Japan's an area I would probably pay attention to. Europe's just basically a museum that is has way too much compliance. What is going on here? It's just a museum with a lot of compliance attached to it. I don't see a lot of great stuff coming out of Europe. I think there's, it's positive, but I don't see they don't have a lot of industry that's going to take them to 20% returns a year consistently like the US does or has recently. So that's just some areas I would pay attention to. Those are the areas that I like so far. I don't know. What are your thoughts, Barb?
I think that was a good rundown on this past year. And what pops into my mind is, okay, so how am I going to invest? How am I going to capitalize going forward? Do I just look at the ones that are down and say, okay, I'll buy those? Am I going to choose individual stocks? Or am I going to choose sector funds, broad ETFs? And so first you have to figure out, am I going to really take a position and look for international stocks in certain sectors that I think are poised to grow? Or am I going to say maybe go with sector funds? That would be my preference. Less risk. And if one of them doesn't pan out, you didn't choose the wrong one. But how do you know just because the sector is down, like Kirk said, you don't want to catch a falling knife. You want to hope that the sector you pick is going to have a reversal. And so you can do a couple of things. First, you want to look at the factors that are going to drive this reversal. And that'll get into some research. You can use Morningstar, you can use Stock Intent, which is a really good new app that I've reviewed. There's a lot of really good research tools out there. And the main thing that I have always looked at when I've picked individual assets is what is their price today, their valuation today, by looking at PE or looking at book value or looking at sales to earnings, those type of metrics. And then what are the growth drivers? Because I have a cautionary tale. Back in the 90s, I was a stock picker. I used to invest predominantly in individual stocks. I've since transitioned into investing basically in index funds. But what I would do was listen to earnings calls, listen and find out what the growth prospects are for the companies. Well, back in the 80s and 90s, Nokia happened to be one of, I think, probably the biggest cell phone manufacturer. And I was enamored with Nokia, but was very, very expensive. Then it dropped significantly, like over 50%. And I thought, okay, I'm going all in. Well, not all in. I never go all in because that's just stupid. So I took a position in Nokia and I thought, wow, I got Nokia. This is great. Did it rebound? No, it never rebounded. I ended up selling it at a loss, which happens when you're an individual stock picker or when you're an investor in general. And I sold it at a loss because there were other companies that came in and they overtook Nokia. It's like betting on AOL, or it's like betting on, technologies that were big in the 1999s that have since gone away. So those are some of the risks you take with the individual investing. Or you can take a completely different strategy, which is decide on a diversified portfolio. And within a diversified portfolio, I always recommend US and global stocks. You can throw in some commodities funds if you want. And then as a ballast, you want some bond funds. You balance those off according to your age, your asset tolerance, your risk tolerance, and also a little bit where's the market now. Kirk, although you didn't use these words, you were referring continually to the idea of return to the mean. There is abundant research that says stock values, asset values return to the mean. If they are overvalued for a long period of time, they're not going to stay that way forever. but we don't know when it will return. At some point, there will be a crash so that their PE, their intrinsic values, will go back to their mean or average value. We have been in a period of a couple of years, really, many years, where stock prices have been significantly overvalued. At some point, that's going to reverse. At the top, you might want to say, I'm going to shave a little bit off my stock holdings. I'm going to lighten up, diversify a little more across maybe fixed income, so that when the reversal comes, I'm not in 80 or 90% stocks. I'm in a little less, so that if my portfolio of equities declines 30%, my entire overall portfolio might only decline 20% or less because I'm not all in stocks. So those are a couple of ideas on how to look at how you're going to go forward within 2025.
Yeah, I think those are great insights, Barb. And I agree. I think it's one of the challenging parts about being a value investor, um, is that value could become more value, right? And people talk about deep value, and that was the old cigar butt stocks thing that Warren Buffett started to learn very early in his career, of just buying things that are valued at less than you could break them up and sell them at. And what he realized very quickly is that that doesn't get you great returns. It's safer because you certainly, as long as they're not burning through cash, it's just a matter of time before it comes out. But I don't think that's a good strategy. And certainly the markets in the last 50 years have kind of proven that out, is that really the best returns come from stocks that are growing. Now, if you're looking at value stocks, and Barb and I are both value investors, we both like value. When I see a discount, I want to go and buy it. Versus most people in the market where they raise the price and then people go buy it, and I just say, I'll just wait. I don't care. There's thousands of stocks out there. I don't need to buy this one. Um, the problem with value stocks is that they could stay in the value realm for a long time and not grow. And there's a handful of examples of this, but if you look at 2008, if you looked at any value manager back then, you'll notice that they all bought the same names: WAMU, Countrywide, and I think there was one other mortgage lender. But they bought them all because they dropped a lot in value because they started to see on Wall Street, like, hey, things are really ugly. And they're like, and the mutual fund manager's like, ooh, look, a value. We can buy more of this stuff. And they bought it and it went to zero because there was a reason it was that cheap, right? And I look at a stock like Diebold. Okay, I'll use an example from years ago. So it's a Diebold, whatever you want to call it. I think they had raised their dividend for like 50 years. They were one of the longest running companies to raise their dividend. I don't remember exactly because it's like 10 years ago, but I believe they were the longest or one of the top three longest. It was like 50 years, 51 years. They had raised their dividend every single year. And they were just dirt cheap. And I was like, wow, they're so cheap. But they keep raising their dividend. I'm like, this is great. And what do? They go and acquire, I think it was Nixdorf or something like that. They merged with another company. And and of course, after that merger, they cut their dividend. And people talked about for a while, oh, they're going to cut their dividend. They never did, and they had the cash flow, so they didn't need to cut it. But after the merger, it turned into a bit of a debacle, and they cut their dividend quite a bit, actually. And GE was the same. I think GE, after they were borderline bankrupt in the financial crisis, they cut their dividend to like a penny. They still paid one, but they cut it basically completely. So, I think the challenge is that when you're seeing these companies and you say, wow, what a great value, they keep raising their dividend. Sometimes they're raising their dividend because they have to. Because if they don't, everyone's going to exodus their stock like rats fleeing from a ship. So they just keep doing it. So you need to make sure, if that's the reason you're buying it, is that they have the cash flow to support it. And it's just for whatever reason the stock market doesn't like it. Now we talked about the The software stocks, which are mainly negative this year and a very positive year, especially for technology, and software stocks are getting killed. And there's one stock that I'm looking at now that is a very good value. The numbers are tremendous. It's software, and basically the reason that people aren't buying is because the street says that they missed the AI boom. It's like whatever. They're minting cash. Who cares? It's not going to kill their stock. Their stock let's just say it's software used every single day. Um, and it's just beaten up and no one cares about it. And the fundamentals are phenomenal. And I'm considering buying it. But I need to wait to see for the market to pick up. So if you're looking for value stocks, sometimes it becomes a greater value and you just need to wait until you start to see upward momentum. Even though it's growing, even though numbers are great, if the stock market hates it, you could be sitting in that stock for 10 years because the stock market hates it. Here's a great example. Okay. Look back at, I'm going to use this as an example. So let's take Microsoft. Okay. So Microsoft, if you go back, and I don't know if this chart goes back far enough, but if you, uh, okay, here we go. So if you go back in Microsoft, uh, well, I don't think I can use this chart. Anyway, I'll do my best. Um, so Microsoft, like every other stock, peaked in 2000, right? Every technology stock peaked in 2000. And then it went down. And do you know it took 15 years to get back to where the peak was in Microsoft? And that was a company that was minting money, literally minting money hand over fist. And I think it was 2012 or 13. I think it was somewhere around there where I was looking at the stock and it was, forget the stock price for a moment. The company kept growing. So even though it took 15 years to get back to that former price, the company kept growing at like 20+% a year. It was nuts. It was so dirt cheap in 2013 or 14 that you could have literally borrowed money from a bank and bought the stock and you could have just owned the company and taken it private. It was insanely cheap and doing like a leverage buyout. Now, it was one of the largest companies in the world, so you couldn't actually do that. But theoretically, you could do a levered buyout on it. It was the numbers were set up. It was that cheap. And I was talking to some friends about it, some people that are maybe bigger names that you might know. And they were seeing the same thing. They're like, this is crazy how cheap this stock is. But it was 15 years. People didn't care about it. And so my point is yes, the company kept getting better and better and better. And yes, Steve Ballmer was in charge, and he literally burned billions of dollars a year doing stupid things like buying that I forget what it was called, but there was it was some software application that was like online phone. You remember what was that, Barb? What was that? What was the name of that?
I remember what you're talking about. I can't remember the name.
Yeah, and people don't use it today. Like it's crazy. It was the dumbest thing ever. But anyway, so it'll come to me. But I think it's probably still on my computer somewhere. I'll see if I can find it. But anyway, the point was is you have this company that is a tremendous company. It's one of my favorite companies in the world, and obviously that depends on the price you pay. Oh, Skype. They bought Skype. They overpaid for Skype, and it just went in the toilet. So my point is you have a great company, one of my favorite companies. If you can get it cheap enough. I don't know if it's just, I don't think it's cheap now, but if you get it cheap enough, it's a great company, right? And there's a lot of great companies out there. They're not the only one. But that was an example I remember of a company that basically sat around and did nothing for 15 years, even though it kept growing. But if you were invested in Microsoft, you had to wait 15 years for positive momentum growth. So you basically burned 15 years. You wasted 15 years of compounding. That's the problem with value stocks, okay? Is that you could get a decade worth of sideways momentum while the company keeps growing and does well. You're not going to see it in the stock price. Now, if you're a value investor, if you're a smart value investor, and some of the best investors of our era are value investors, right? Look at Warren Buffett, look at Seth Clarin at Baupost. You look at a lot of these guys that are really, really smart. It's because they're looking at this and saying, is the company continuing to grow? Am I paying a good price for it? And most of these guys are willing to sit on it for 5 years because They're like, hey, it's a great stock and I'll just sit on it because it's going to keep growing. Um, now, most people can't do that. Or let me rephrase that. Most people are unwilling to do that. Okay. I, for one, can't afford to do that. Right. As a financial advisor, I actually have different metrics I have to abide by. Right. So Barb can buy a great stock and sit on it for 10 years and she could be happy, even though it doesn't grow, because the company will eventually grow and it'll make up for it and she'll be happy. I'm the same way. I do the same thing. I just let it sit and it'll just keep growing. As long as the company's fundamentals are sound, eventually it'll catch up. Now, the problem is if you have a financial advisor, and I am under the same boundaries, is that if I were to buy Microsoft in 2004 and I had to wait until like 2015 to start making money, I'm going to get fired, right? I'm going to get fired because that's 10 years of no growth. Clients will fire me. Now, am I doing the right thing? Yes. Am I going to get credit for it? Absolutely not. So I think one of the challenges that people have is not just your own psychology, but if you're using a financial advisor, you're relying on them to do things, and your basic metric is this person making money for me? That's it. That's all people look at. Are you making money for me? What have you done for me lately? Now, I could sit there and argue with you for years that this is the right thing, and eventually you're going to be like, yeah, I don't buy it anymore. Go pound sand. I get it. I've been doing this for 26 years. I understand. And the challenge for a lot of people are how do you balance that? How do you balance doing the right thing versus, getting your dopamine hit of what have you done for me lately? And I'm not saying clients are wrong. I'm not saying that that metric is wrong. I'm just saying that is another layer that investors have to deal with. It's not just can I deal with 10 years of sideways momentum despite the fact that the company keeps growing and I'm doing the right thing? Can I deal with that? Most people, the answer is no. And I would say even value managers, the answer is probably no. So you can't just fall into the realm of only fundamental or only technical. You have to combine the two. You have to look for momentum and value because the value has to be recognized at some point. If it's not being recognized, you just wait. You go invest in something else. Sit in CDs getting 4% or 3.5% now. You're getting 3.5%. At least you're getting something while you wait. And when it starts to pick up, then you can buy it. But don't get too over eager. It could go sideways for longer than you have your tolerance to do so. So anyway, I just wanted to kind of float that out there because Barb and I, we both. I won't speak for Barb, but as value investors, this is something you have to deal with. Momentum investors, you're just riding the you're just you're just riding the horse. Like let's go. And then the horse bucks you off. All right, let's get on to something else. It's a different framework, right? And of course, there's more risk in that, but at the same point, you have to understand the pros and cons. So, what are your thoughts, Barb, as a fellow value investor?
I pretty much agreed with what you said about the value investing. And I wanted to share a story about Microsoft and my dad, who happened to pass away in 2013. So he was a big investor. He loved investing. He studied investing. He introduced me to investing when I was quite young. And he used a variety of different strategies. He was a lifelong learner. But one thing he did with Microsoft over the years, I remember him explaining this to me. He recognized that Microsoft was very volatile and that it would go up for a while, then it would go down, then it would go up for a while, then it would go down, then it would go up for a while. And my dad capitalized on that trend by repeatedly buying Microsoft at the bottom, selling at the top, and repeating that for a while. Now, that's something I don't do. That's not my strategy. But I just put that out there as another way to look at trends, actually, for those people that might be technical investors. And he profited very nicely from that. The other thing I wanted to mention, because we don't talk about this enough, and that is the trading aspect and the patience. Now, 15 years is a little long, even for me, to wait for a stock to perform unless it's paying, a 5+% dividend. And then I'm happy to wait because I'm getting 5% a year. But those of you who believe that, oh, I need to see results immediately, are going to lose out. Part of investing is making a decision, doing your research, finding companies to invest in, and then giving them a chance to reach their value. Not to say, oh, it didn't pan out in a year, it didn't pan out in 2 years. If they're still on the right path, sometimes it's best to wait. And then the second point I wanted to mention that is rarely discussed, and I kind of touched on this in my last rant, was when we are in a very overvalued market, there's no harm in sitting on some cash. And although I would never compare myself to Warren Buffett has had periods where his company has sat on a very lot of cash because he's not finding things to invest in. And sitting on cash, depending on what the inflation rate is, I mean, today you're going to earn 3% on your cash. The inflation rate is probably about 3%. So you're pretty much not losing money and you're not benefiting. But if and when there's a stock market decline, well, then you've got some cash to jump in and buy some valuable companies at lower prices.
Yeah, so I agree. I think, and just for context, Warren Buffett has like 33% of his stock in cash. 33% that is in cash right now.
So
Um,
I am really right.
yeah,
I am very correct.
yeah, yeah. But Warren Buffett is right now is very conservative. And when I say Warren Buffett, it's really his team because he's involved, but he's basically retired, I think, as of tomorrow. So, technically he's probably still involved. He's probably still talking and having conversations about stuff, but they just bought Google like a month ago. I think they just bought Google as a big position. So, they tend to, I mean, he bought Apple years ago and then he sold it because it hasn't grown revenues in 3 years, 3.5 years, or profits or earnings. So that's a totally different thing. I did want to, before we wrap it up, I did want to share a few of these because I thought these were interesting. So I want to share a few. Okay, so this one's the whole market by market cap. And I thought this is interesting because if you look here, you see the large cap stocks are getting most of the love. As you get into the mid caps, they're getting some love, but a little less. Small caps, definitely, less. And you got nano, micro, you're getting like a lot of red in a year where the markets are up. So anyone who wants to invest in penny stocks because you're going to go to the moon, good luck to you. You're better off investing in large cap if you want to go to the moon, oddly enough, even though that is totally contrary to logic, but that seems to be what's happening. So I would just be careful if you're trying to penny stock your way into riches. It's like going to the casino and hitting the one-armed bandit and assuming you're going to hit the big bucks or betting on the lottery. Just don't do it. Just stick with what works, and what works tends to be large cap, mid cap, and even some small cap, although small cap's actually been underperforming for a long time. So I would just be careful. Another one I want to share, this is global. So this is the global market indexes. So this is not US, by the way, because US is a totally different one. So they exclude the US here. So you got Canada, which is basically Canada's resource based. So there's a lot of resource stocks up there. There's some bank stocks like TD and I can't read them on here, but anyway, so there's a handful of financial stocks which actually have done quite well, but a ton of resource stocks. Canada is known for that. You've got a lot of resource stocks in South America. If you go over to you go to China and Asia, you got a lot of technology. Japan, you've got technology. Australia got basically one stock. So there's if you look globally, it's really interesting to see what's done well. I'm going to make this point. is let's look at Israel for a second. Now, this is actually a screenshot, so I can't zoom in. Um, because of what's happened over in Gaza, everyone assumes that, well, you can't invest over there because it's a disaster. You know what's been a great performing index? The Tel Aviv index. I forget what it's called, but it's that the Israel market has been going like gangbusters this year. And, you know, I think frequently we look at areas of distress and we say that's uninvestable. Like when Ukraine war started, immediately the markets over there plummeted for about a week, and then they started to take off. Why? Well, because apparently Europe needs to boost up their defense budgets, and Trump kind of forced their hand to do that as well. And so Europe's been doing great because now they have to spend a lot of their money on defense, which is money going to their economy, right? Um, there's a bunch of examples like this. Look when the trade deals happen in April when Trump the taco trade, right? Trump always caves. So if you look after that, a lot of areas globally did really well. The global markets started to take off. So you might normally think, well, America first, yes, but it doesn't necessarily mean everything else is going to sag. Here's another example. Obama was elected and he was anti-gun, or the Democrats are, I should say. They're anti-gun and they want to take away your guns and all that. And that's part of their platform. Not mincing words. It's verbally a part of their platform. You might agree or disagree. It doesn't really matter, right? So Obama gets elected and what happens? Gun stocks were some of the best performing stocks in the economy. Why? Because everyone's afraid they're going to take us guns. So what are we going to do? We're going to go buy a bunch of guns. So Obama was the best gun dealer out there because he caused everyone to go buy guns and ammunition. And yeah, there were some things put in place to curtail that industry. But at the same point, they made a lot of money because people went out and bought a bunch of stuff. So on the surface, you might look at things and say, this is bad. This is bad for this thing. Well, if you think it through, it actually could be really good for it. And frequently it is. Here's another one for these are different sectors. This is the kind of a composition of a lot of different things. So I like looking at this. Finviz is not a sponsor of the show. They should be. All the airtime we give them. But if you look at a lot of this stuff, it gives you a good snapshot of what's going on. What are the areas that are a problem, right? Here's another one. What's done poorly this year? Crypto's done very poorly this year. And you wouldn't notice that because this should have been a great year for crypto. Was it? No, it's negative. Bitcoin's down, Ethereum's down, pretty much everything's down. Why? You'd think it did really well because, they came out with ETFs and all that. No, it's down. And if you were heavy into crypto, you're probably in pain right now. But it doesn't mean it's going to last forever, but it's just something to keep in mind. Wow, that's a really terrible sector. Here's the futures market. Now, I realized it took me a second to realize why S&P 500 says 12%. That's because these are futures. The futures don't perform the same as the index because the futures there's a roll cost. Anyway, it's about 17%, but according to the futures, it's only up 12. So the futures returns don't necessarily equate to the returns of of your ETFs. The ETFs, if they own the shares, they will typically have a different kind of return. Anyway, so this is the area we were talking about before. The grains have done very poorly. The bonds have done a little bit positive. Equities have done very well. Energy has not done very well. The softs, except for coffee, have not done well at all. And then currencies. Currencies have all done really well compared to the dollar. And then metals, obviously metals have gone gangbusters. And then finally, this is, I think, all stocks in the U.S., and you can just see what sectors have done well and which haven't. Obviously, software has done oddly poorly given the AI boom. Real estate has done poor, energy, and then you got some other sectors, I can't read these, but like airlines and staffing and anyway. So I just wanted to share all that. And by the way, this is I don't know what this is. Well, anyway. So I just want to share all that as we kind of wrap up here, just get a year-end look at the markets and to get a sense of kind of what's going on, what happened this year. And so as you kind of look into next year, you should start to, I'm going to leave you with this, and I'm going to give it to Barb to wrap up. Here's how I would wrap up the year. At the end of the year, if you're still, well, you're not seeing this because it's going to come out after the end of the year. But for future years, what you should do is look at the end of the year and say, all right, where is everything? Did I do all my tax loss selling? Okay, hopefully you have, because you'll get this message way too late. But at the end of the year, you want to do your tax loss selling. Always look for positions that have done poorly in the year, and it's a good idea to tax loss sell those. And you can do a lot of things, and I'm not a tax advisor, so don't take this for tax advice. But if you're selling your Bitcoin, let's say you're taking, you have a loss and you're selling your Bitcoin, you can buy back a different form of that. It can't be identical, but it can be a similar form as a way to get exposure to Bitcoin. So, for example, you might sell Bitcoin, but buy MicroStrategies as an example. Something that performs similarly. And so it's a good time to sell your positions that are a loss and then buy something else, and then you can swap it back later. Like I said, talk to your tax advisor as ways to do that, because there are some nuances, some things you want to watch out for, but generally speaking, there's a lot of things you can do to protect yourself. So you also want to think about, like, as of January 5th, is January 2nd is actually a Friday and no one's working, so I'm going to assume that's still a holiday. But if you look at January 5th on Monday, that's when the real traders get back to work, and that's when you want to watch, like, where's all the money flowing? So if the money, it's like when Trump got elected, you saw where the money go. The money went into financials, it went into technology, it went into a lot of areas, and that's what's done well this year, right? So you want to watch for signs, and the first week of the year, you're going to start to see signs of where the money should flow. If it starts to go down, you want to be very careful. But most years it goes up, and that's a sign of the rest of the year. So you want to be mindful of, all right, which sectors are getting a lot of money. I would argue that precious metals are going to see a big flow because this year was a gangbuster year and people didn't realize it yet. But there are other areas like healthcare, I would suspect, are going to do well. Energy, I think, will probably do well close to the election, but maybe till then not. Financials probably continue to do well. There's a lot of areas that are, let's say, out of favor that are getting into favor, and you might want to just pay attention to that. Anyway, so Barb, wrap us up here. You get the final thoughts for 2025.
Don't forget international stock investing. This past year shows that you cannot avoid that part of the world. The US is approximately 40% of the world stock market. And the question is, the issue is valuations matter. The valuations are a lot higher in the US than they are or have been globally. So over time, if history has any chance of repeating itself, lower valuation assets have a greater probability of delivering outsized returns. So personally, and this is not advice, but I always keep from 17 to 20% of our family investment portfolio in global ETFs. And this year we were rewarded. There were many years we were not rewarded. And that's where the patience comes in. I will reiterate, don't be afraid to hold some cash. I am Barbara Friedberg. You can find me on my YouTube channel, also at Barbara Friedberg Personal Finance, where you will get a lot of sound, basic investment advice.
Awesome. Well, thanks, Barb. Thanks for a wonderful 2025. Please check out Barb's website for more education on personal finance. So that's it for the year. That's it for 2025. We're wrapping it up here. It was a wonderful 2025. I had a lot of fun. Hopefully you did as well. Hopefully you learned a lot. We got a lot of fun stuff in store for 2026. I'm excited to kind of roll some of that out for everybody. So thank you again. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.